Across America, the rental market is unraveling at a pace unseen in decades. Vacancy rates have tripled from 3% to nearly 10%, inventory has ballooned to 7 months, and units once commanding $2,400 now struggle to rent at $2,100. Landlords are slashing prices by $100 a week, desperate to attract tenants who no longer exist. For the first time since 2009, rents are falling nationwide, signaling not a soft landing, but the beginning of a systemic collapse. The illusion of housing stability has shattered, exposing a fragile economy where affordability has vanished and the power balance has violently flipped. Just 3 years ago, Americans were fighting over apartments, lining up for showings, offering 6 months of rent up front, and begging landlords not to raise prices. That chaos is now history. The pendulum has swung so violently that the same cities once choking under rental scarcity are drowning in excess supply. How did the nation go from historic shortages to an oversupply crisis in less than 24 months? The answer lies in a perfect economic storm that rewired the entire housing system almost overnight. When interest rates exploded from 2.9% to over 7.5%, the entire home buying pipeline froze. Millions who bought at peak valuations suddenly couldn't sell without massive losses. At the same time, corporations began recalling remote employees to physical offices, dismantling the very reason many families relocated during the pandemic. A buyer in Texas who once worked for a New York firm suddenly had to return, but their new home in Austin wouldn't sell. So, they listed it for rent. Multiply that by hundreds of thousands of households, and you get an invisible wave of new landlords flooding the market. Economists call them accidental landlords, but the truth is far uglier. These are not investors by choice. They're financial hostages. Most are renting their homes below cost, losing $500 to $1,000 every month just to avoid foreclosure. Their desperation has injected hundreds of thousands of additional rental units into already saturated markets, pushing vacancy rates beyond sustainable levels. According to the Federal Housing Finance Agency, single-family rental listings have surged 42% year-over-year in major metros, reversing a decade of chronic undersupply. Meanwhile, institutional investors, the ones who bought entire neighborhoods with cheap pandemic loans, are panicking. Many of their rental portfolios are underwater as yields collapse, and refinancing costs skyrocket. Cities like Phoenix, Nashville, and Charlotte, which were once the darlings of real estate investors, now report record-high lease terminations and forced rent cuts exceeding 15%. This isn't a small correction, it's a structural flip. The power has shifted from those who owned property to those who occupy it. For the first time in modern housing history, tenants dictate the price, not landlords. And this reversal isn't temporary. It's the opening act of a nationwide reset, where the supply chain of shelter itself begins to fracture under the weight of its own greed. The rise of accidental landlords has created a chain reaction that is now destabilizing entire housing ecosystems. When thousands of homeowners trapped by high-interest mortgages and falling property values start renting out their unused homes, they unintentionally trigger a price war that no one can win. These individuals are not property moguls. They're over-leveraged households, often carrying mortgage payments of $3,000 while collecting just $2,200 in rent. Every listing they add intensifies the imbalance, flooding markets with units priced below profitability yet still beyond affordability for average renters. This phenomenon has already reshaped regional dynamics. In places like Dallas and Atlanta, single-family rental supply has surged more than 35% in a single year, overwhelming traditional investor portfolios. Institutional landlords, once dominant, are now forced to compete with individuals willing to absorb losses simply to cover part of their mortgage. As yields shrink and carrying costs soar, what was once a thriving asset class is turning into a liability tsunami. The very structure of rental economics is collapsing under unsustainable debt and false optimism. Banks are quietly alarmed. Internal reports from mortgage lenders show a growing wave of negative equity rental homes, properties now worth less than the loans attached to them. This inversion is significant because it transforms homeowners into reluctant debtors rather than long-term investors. It's no longer about profit, it's about survival. The oversupply from these unintentional landlords has shattered pricing discipline, erasing years of market gains in a matter of months. Even large-scale property management firms are beginning to fracture under the pressure. Maintenance costs, insurance premiums, and property taxes have risen by double digits since 2021, leaving no margin for error. As more accidental landlords fail to fill vacancies or meet payments, foreclosures will begin returning in waves. Analysts estimate that up to 18% of these new rental conversions could default within the next 12 months if conditions remain unchanged. The rental sector is no longer defined by investor strategy, but by financial panic. The system that once rewarded leverage and expansion is now punishing it with precision. What began as a simple act of renting out unsold homes has morphed into a nationwide financial contagion, one that's quietly dismantling the illusion of stability across the entire housing market. As landlords drown in excess inventory, a quiet revolution is unfolding. Tenants, once powerless victims of soaring costs, have seized control of the market. Across the country, renters are dictating terms, demanding reductions, and walking away from overpriced listings without hesitation. Data from Rent.com shows that nearly 64% of tenants who renewed leases this year negotiated lower rents or secured incentives like free parking or waived deposits. The shift isn't emotional, it's mathematical. With supply exceeding demand, the leverage has decisively changed hands. In real time, the rental economy has transformed into a bidding war in reverse. Instead of tenants outbidding one another, landlords are now competing for occupancy. Online marketplaces are flooded with units cutting prices every week, a phenomenon once unimaginable in post-2020 America cities that once symbolized explosive growth like Austin, Denver, and Tampa are now case studies in deflation. Median rents in some zip codes have fallen 18% since their 2022 peak. While national vacancy rates have reached the highest level in over a decade, the psychological impact is equally severe. Tenants now recognize that every passing month works in their favor. When expectations shift from scarcity to abundance, urgency dies, and with it, market momentum. Leasing agents report a 40% increase in showing cancellations as renters deliberately delay decisions, anticipating further declines. This behavioral freeze is magnifying the collapse far beyond what raw data suggests. Property owners are now cutting deals that would have been unthinkable just 2 years ago. Free months, flexible leases, utility credits, anything to retain tenants in a contracting market. Yet these discounts come with a steep cost, collapsing yield structures and evaporating confidence. The traditional rulebook, location drives price, no longer applies when oversupply exists in every direction. This new power dynamic signals more than a temporary correction. It represents the disintegration of the post-pandemic housing illusion. The American renter has become the central economic actor, not through wealth, but through scarcity of necessity. For decades, ownership dictated power. Now it's the ability to walk away that shapes the market. The era of landlords dictating terms has ended abruptly, replaced by a reality where empty units scream louder than price tags, and every vacant door tells the same story. Control has changed hands. While landlords fight to fill empty homes, another crisis is erupting deeper in the construction sector. A structural oversupply built on delusion. Between 2021 and 2024, more than 1.2 million multifamily units were launched across the U.S., the highest level in half a century. Developers, intoxicated by pandemic-era rent spikes and cheap financing, assumed endless urban demand. What they built instead was an economic time bomb, now detonating in slow motion. Markets like Austin, Jacksonville, and Phoenix are the epicenters of this overbuilding wave. In Jacksonville alone, 7,000 new units entered the market in just 12 months, with another 11,000 under construction. Those numbers are unsustainable in a city where population growth has already slowed below 1.5% nationwide. The pipeline of new apartment projects exceeds 1 million units, enough to suppress rental growth for years. The irony is brutal. Construction didn't stop when demand did. because once financing is secured, projects must be completed to satisfy bank covenants. That means thousands of new buildings will keep arriving long after tenants have vanished. To survive, developers are igniting a price war of incentives. Free rent for 3 months, zero security deposits, even luxury giveaways like TVs or gym memberships. These tactics signal distress, not prosperity. Yet even with giveaways, effective rents continue to drop, erasing profitability across the board. Data from RealPage shows effective rental income per unit down 12% nationwide in 2025, with net absorption turning negative in multiple metro zones for the first time since the Great Recession. Construction debt is the next fault line. Billions in variable rate loans tied to projects are coming due in 2026 at double or triple their original interest costs. Many developers are already negotiating forbearance to avoid defaults, but the arithmetic no longer works. Rising material and labor costs collided with falling rent revenue, a fatal imbalance. The overbuilding frenzy didn't just saturate cities with units, it dismantled the illusion of permanent demand. This glut ensures that even if the economy stabilizes, recovery will be delayed for years. Supply is now a weapon turned against its creators. Concrete monuments to greed, financed by optimism, and destined to stand half-empty as symbols of a market that mistook temporary inflation for eternal growth. Beneath the collapsing rent prices and construction chaos lies the single most devastating truth: Americans can no longer afford to live in America. The affordability crisis is not a side effect. It's the core fracture splitting the entire housing system apart. Median household income has risen only 12% since 2020, while average rent surged nearly 35% at its peak. Even after recent declines, the financial gap remains catastrophic. To qualify for a $3,000 rental under the traditional 3 times income rule, a tenant would need to earn $108,000 annually. Yet, according to U.S. Census data, the median household income stands at just $74,580. That means millions are locked out of the rental system entirely. Landlords are being forced to rewrite the rules of entry. Across multiple markets, the income requirement is being lowered to 2.5 times rent. Credit score minimums are being relaxed, and deposits are shrinking, all measures of desperation, not generosity. In places like Miami and San Diego, property managers report applications from tenants spending over 45% of their income on rent, an unsustainable ratio that historically signals economic distress. At the same time, hidden costs have quietly multiplied. Utility surcharges, maintenance fees, and mandatory renter's insurance have turned affordable units into financial traps. The illusion of cheaper rent dissolves once these charges are added back. According to the Bureau of Labor Statistics, overall shelter inflation is still up 26% since 2020, meaning even with falling listed rents, the actual cost of living hasn't meaningfully improved. This affordability collapse is hollowing out the middle class. Teachers, nurses, and municipal workers, once the backbone of stable neighborhoods, are being priced out of the very cities they serve. The result is a new geography of inequality: booming vacancy rates in downtown luxury towers and growing overcrowding in distant, decaying suburbs. The data paints an unmistakable picture. Nearly 21 million U.S. households now spend more than half of their income on rent, the highest ratio in recorded history. It's not a housing market anymore, it's a survival lottery. Affordability has become the new frontier of collapse, where every paycheck measures how close a family is to eviction, and every price cut is a symptom of a system that's already failed. While long-term rents crumble under oversupply, the short-term rental empire is disintegrating under its own excess. The speculative gold rush that turned family neighborhoods into miniature hotels has reversed. Airbnb occupancy rates have plunged from 57% to barely 49%, a nationwide collapse unseen since the pandemic lockdowns. Behind those numbers lies a brutal truth: the math that sustained the short-term boom no longer works. Operating costs have exploded. Insurance premiums for vacation rentals are up more than 280% since 2019, while maintenance, cleaning, and compliance fees consume nearly 40% of gross income. Cities from Los Angeles to New York are tightening restrictions, imposing heavy fines, up to $30,000 per violation, and enforcing stricter licensing laws that wipe out small hosts overnight. The speculative class that once dominated social media with Airbnb passive income is now vanishing quietly, forced to sell or convert properties into long-term leases at steep losses. The scale of saturation is staggering. Phoenix went from 5,000 short-term listings in 2017 to over 21,000 by 2025. Austin and Nashville followed the same trajectory, with more short-term units than hotel rooms. As occupancy rates fall and nightly prices collapse by 25% or more, most hosts are discovering they can't even cover mortgage payments. The short-term rental market, once hailed as democratized wealth creation, has transformed into an engine of financial ruin. The fallout extends beyond individual owners. The mass conversion of failing Airbnbs into standard rentals is injecting millions of additional units into an already flooded housing pool. Analysts estimate that even a 10% reconversion rate could increase U.S. rental supply by 200,000 units, enough to erase any chance of stabilization for years. This influx crushes margins for traditional landlords and amplifies the deflationary spiral gripping the entire sector. What began as a side hustle revolution has devolved into systemic disruption. The Airbnb crash exposes how speculative greed destabilized entire housing regions, distorting prices far beyond their economic base. It wasn't tourism that destroyed affordability, it was financial fantasy. The promise of endless guests has been replaced by endless vacancies. Short-term greed has triggered long-term damage, leaving behind a distorted marketplace where even luxury properties can't escape the gravitational pull of collapse. The fallout from collapsing rents and overbuilt markets is now hitting the final layer of the housing pyramid: investors. What was once the most stable asset class in America has turned into a financial sinkhole. The same investors who fueled the pandemic-era housing frenzy are now drowning in negative cash flow, rising costs, and vanishing equity. According to Redfin data, nearly 18% of all investment properties purchased since 2021 are now losing money every single month. The arithmetic that once justified aggressive leverage no longer holds. Property taxes have jumped an average of 19% nationwide since 2020. Insurance premiums have tripled in disaster-prone regions, and repair costs have soared by over 30%. For a single-family investor, that means every vacant month or price cut destroys profitability. Even institutional funds that once boasted guaranteed yield models are quietly revising expectations downward, with some reporting effective annual returns under 2%, barely above inflation. The pressure is compounded by refinancing risk. An estimated $1.5 trillion in commercial and multifamily real estate loans are set to mature by 2026, much of it financed at ultra-low rates. Now, those loans must roll over at 6 to 8% interest, transforming modestly profitable portfolios into high-risk liabilities overnight. Delinquencies on multifamily debt have already doubled compared to 2022, signaling the early stages of a credit contagion. Private equity-backed landlord groups are quietly offloading assets in secondary markets, often at 10 to 20% discounts, just to generate liquidity. Institutional buyers that once dominated suburban development pipelines have frozen acquisitions entirely. The irony is that Wall Street, which once promised stability through scale, is now accelerating volatility by exiting en masse. The ripple effects reach pension funds, REIT investors, and everyday retirement accounts tied to housing-backed securities. The illusion of real estate as a guaranteed hedge has shattered. In a deflating rent environment, appreciation no longer masks operational losses. Every expense increase compounds the pain, every vacancy magnifies the losses, and every rate hike erodes asset value further. The same leverage that magnified profits during the boom is now multiplying pain during the downturn. What emerges is a landscape stripped of illusions, an industry built on debt now collapsing under its own arithmetic. investors are discovering a brutal truth. Cash flow, not speculation, determines survival. For many, this decade will not bring wealth through property, but a reckoning measured in defaults, forced sales, and financial erosion that will echo long after the headlines fade. The collapse in the rental market is no longer confined to real estate. It is bleeding into the broader economy, triggering secondary failures that most analysts still underestimate. Housing is not just shelter. It is a core pillar of employment, municipal finance, and consumer spending. When this sector implodes, the aftershocks ripple through every layer of society. Construction jobs are the first casualties. With new developments stalled and existing projects struggling to fill units, more than 250,000 construction-related positions have vanished in the last 12 months. Manufacturing demand for materials like lumber, concrete, and steel has dropped by double digits, dragging entire supply chains into contraction. The slowdown extends to local economies that once thrived on real estate momentum, from electricians and landscapers to hardware stores and furniture retailers. Each empty apartment represents not just lost rent, but lost economic activity cascading through multiple industries. Municipal budgets are next in line. Property taxes, which fund nearly half of all local government revenues, are falling as valuations decline. Cities dependent on high-rent developments, such as Austin and Miami, are reporting revenue shortfalls that threaten essential public services. Lower property income means fewer infrastructure projects, hiring freezes for teachers and police, and mounting fiscal deficits. The housing crash has quietly transformed into a municipal finance crisis, one that few city councils are prepared to confront. Regional banks are also being exposed. Many hold substantial portfolios of multifamily construction loans, and investor mortgages now at risk of default. Rising vacancy rates mean shrinking collateral values, forcing institutions to increase loan loss reserves and restrict lending. The feedback loop tightens credit availability, choking small businesses already struggling with inflation and reduced consumer demand. Consumer psychology completes the contagion. As rents decline, so do expectations for asset growth. Households reduce discretionary spending, saving more out of fear. Retail sectors dependent on housing confidence, appliances, renovations, and home goods, are entering contraction. The economic pulse of the nation slows as one market drags down many. What began as a rental correction has evolved into a systemic contagion, eroding the foundations of local economies. Housing is the bloodstream of the American system, and as it weakens, the organs it sustains begin to fail. The crisis no longer measures itself in square footage or vacancy rates, but in the speed at which it spreads through every corner of the national economy. The rental collapse has dismantled the illusion of perpetual growth and revealed the hierarchy of survival within America's housing system. The winners in this reversal are not the wealthiest. They are the adaptive, those who recognize that leverage and optimism no longer guarantee security. For landlords, the age of effortless profit is over. Survival now demands price realism, tenant cooperation, and cost discipline. Vacancy is the new penalty for greed. Those who refuse to adjust will watch equity evaporate faster than any interest rate can rise. For tenants, the brief window of leverage is not a victory. It's a warning. Falling rents do not signify relief. They signal decay in the underlying economy. Lower prices are being fueled not by prosperity, but by desperation. The same forces driving landlords to cut deals are the ones eroding wages and job stability. The balance of power has flipped, but both sides are losing ground under the same economic gravity. Investors face a longer and harsher reckoning. A decade once projected for growth has become one defined by stagnation. Portfolios built on inflated expectations must now navigate years of suppressed appreciation and minimal returns. The lost decade is not speculation. It's arithmetic. Every over-leveraged property, every delayed sale, and every failed refinancing compounds the drag on recovery. The broader economy will not escape this reversal. With construction pipelines shrinking, credit tightening, and municipal revenues collapsing, the consequences will stretch far beyond housing. The American dream, once defined by ownership, now stands on the edge of redefinition. Shelter has reverted from asset to liability, from investment to expense. The data tells a story more powerful than any forecast. A structural reset, not a temporary cycle. What began as a rent correction has evolved into an era of forced realism, where markets built on hype return to mathematical truth. The rental market's implosion is not an isolated event. It's the first visible crack in a system overloaded by debt, speculation, and policy failure. This is the great reversal of modern housing, where value dissolves, wealth compresses, and survival replaces ambition. What comes next will not be recovery, but revaluation. The easy decade is over. The correction has only just begun.